So quantitative easing. You've probably heard about this term QE around in the news, especially when the economy starts to look shaky. It sounds super complicated, maybe a little intimidating, but what is it really? That's what we are going to do right now. Pull back the curtain on QE, break down exactly what it is, why central bank uses it, and then connect it to what the Fed just did in its December 10th announcement. First, imagine this. The entire economic engine of a country just grind to an halt. People stop spending, companies stop hiring, banks stop lending. The lifeblood of the economy, money, stops circulating, and growth just stalls out. It's the kind of nightmare scenario that keeps economists up at night. And it's exactly the kind of problem QE was originally created to fight. Fear freezes the system before talking about the cure. We need to understand the sickness. Think of money as the lifeblood of the economy. It's not just about the cash in your wallet, it's about the movement, transaction. Money constantly flowing between household, businesses, banks, and the government. In a healthy system, that endless circulation is what creates jobs, growth, and buys in incomes. Here's how it's supposed to work in a perfect world. The central bank, like the Federal Reserve in the US, or the Bank of Canada up north, provides money to the big commercial banks. Those banks then lend that money out. People borrow for houses, companies borrow to build new factories, entrepreneur borrows to start a new business. This cycle of borrowing and spending is what makes the economy grow. But what happened when the loop breaks? What happened when you get a blockage in the system? Almost every time, it boils down to one powerful emotion: fear. When people get scared about losing their jobs, they don't borrow for a new car or a bigger house. When the banks get scared, they won't be paid back, they slam the brakes on lending. When companies see sales dropping, they cancel expansion plans and sit on cash. Suddenly everybody is hoarding money, and the whole system sees up. The engine has stalled. Traditional tools runs out when this happens. Central banks go to their standard playbook. Their number one tool is interest rate. They slash rates to make borrowing cheaper, so more people and businesses will take loans, spend, and invest. On paper, it makes perfect sense. Cheaper money should get things moving again. But there's a huge weak spot. This tool depends entirely on confidence. You can offer someone cheap loan, but if they're terrified about the future, they won't take it. Banks might borrow super cheap money from the central bank, but instead of lending it out, they just park it somewhere safe. The money gets stuck in the pipes and never reaches you and me. In past crises, central bank pushed this tool to the limits, cutting rates all the way down to close to zero. Yet, when an entire economy is frozen solid by fear, even near free money isn't enough to thaw it out. So the weapon number one is basically a bust. The main tool is broken. The engine is still on life support. So what do we do? Enter quantitative easing. That's when central banks reach into the back of the toolbox and pull out something unconventional, powerful and controversial: quantitative easing. At its core, QE is the central bank creating brand new money out of thin air. Not by running the printing press, but by typing number on a computer. With this new digital cash, it goes out and buys assets, usually government bonds, directly from the big commercial banks. Think of it like a giant swap. The central bank creates, say, $1 billion, uses that money to buy $1 billion worth of bonds from a bank, and instantly that bank's balance sheet changes. Instead of holding a bond, now it's holding a pile of fresh cash, ready to be used. The whole point of this massive financial maneuver is to fix the original problem: jammed up money pipes. The central bank is trying to flood the banking system with so much cash that bank finally feels safe and motivated enough to open up the lending tapes and get money flowing out to the real economy again. Which brings us to the $1 trillion question. Does this actually work? The central bank can give a commercial bank a mountain of cash, but it cannot force that bank to approve a small business loan. It cannot make nervous families sign up for a new mortgage. QE, quantitative easing, provides the fuel, but it cannot force anyone to step on the gas. Basic supply and demand says, if you flood the world with more dollars, the value of each dollar can fall. That can upset the countries that holds a lot of US assets and can trigger the tensions or currency war type dynamics as other central bank reacts. Another big risk is where the new money actually ends up. Instead of funding new businesses and jobs, it can flood into the financial market like stocks, real estate, or commodities, pushing prices up and creating dangerous bubbles. On December 10, 2025, the Federal Reserve cut interest rates again, lowering its key policy rate to a range between 3.5 to 3.75%, the lowest in several years, even though some officials openly disagree. At the same time, the Fed announced it would start buying roughly $40 billion of short-term treasury bills per month after officially ending its quantitative tightening program on December 1st. Quantitative tightening, or QT, is basically the opposite of QE. This time, the Fed is very careful with its language and may avoid calling it QE, but the mechanics rhyme with what we have just learned. Stop shrinking the balance sheet, start buying government securities again, and inject extra cash liquidity into the system to keep funding markets stable. In other words, the story of QE isn't just something from 2008 crisis or the pandemic. It's still evolving right now, in real time. They're calling it reserve management purchases as policymakers trying to balance slowing growth and softer labor market and sticky inflation. And that brings us back to the big unresolved question. Is this kind of policy an ingenious set of tools that keeps the engine from stalling, or a dangerous habit that just kicks the problem into the future and inflates new risks somewhere else? The truth is, the debate of QE and QT and these new treasury bill buying program is far from over. And the December 10th decision is just the latest chapter in that ongoing story.